Okay, so we got a whole new class of covered call ETFs coming out of the US, and now most recently the first one's arriving in Canada last month. Now, if you're impatient from getting paid out your distributions only once a month from your covered call funds, look no further. We now have weekly and bi-weekly paying covered call funds. So stick around to the end of this video and find out which ones are worth holding and which ones are nothing but hype. Hey everyone, welcome back to the channel. If you're new here, I'm Patrick, been an investor for over a decade, an options trader for 7 years, and in crypto for 7 years. I've grown my portfolio to over $250,000, and I run Apex Wealth Collective, a school community for investors where you can follow my portfolio journey and experience it with me firsthand. Now, covered call ETFs have made a huge comeback just after 2020 and have exploded in popularity since then, providing many people a new steady income source that they can rely on to not only pay their bills every month, but fully retire them. But very recently, people have been going into an absolute frenzy on social media and hyping up these weekly and bi-weekly paying covered call ETFs. Now, are they useful or are they just smoke and mirrors? Well, as you guys may or may not know, I hold two specific covered call funds in my retirement portfolio that I absolutely love, and their consistent performance speaks volumes that not many others can really beat their total returns so far. For me, these two funds are HDIV.to and QQCL.to. If you missed my video I made about these two funds, you can go ahead and find the link to that video in the description below. Now, for every covered call fund comparison video that I like to make, like the one you're watching today, I like to use HDIV.to as our benchmark covered call fund to see if these new products are competitive or just hype. So far, I have mostly been disappointed, to be honest, but let's check out these new weekly and bi-weekly paying covered call funds and see what they're all about. And then we will compare them all to our benchmark, HDIV.to, and see what we're working with. But before we get into the meat and potatoes of this video, give this video a like if you find it useful, hit that subscribe button, and let's get into it. So first, we will discuss some of the popular US market weekly paying covered call funds, and then we'll look at the brand spanking new Canadian bi-weekly paying covered call funds just released by Hamilton ETFs. For the American funds today, we will be looking at XDTE, QDTE, and RDTE from Round Hill Investments, and some more speculative and super popular funds like YMAX and YMAG from YieldMax. So first off, let's talk about the triplet weekly paying covered call funds from Round Hill Investments. All three funds, XDTE, QDTE, and RDTE, sell 0 days till expiry covered calls on their respective underlying indexes. So they are very actively managed funds. Now, what are 0DTE covered call options, you may ask? Well, it's basically what the name implies. You sell a covered call option that expires the exact same day by market close. So these covered call options are being sold and expiring the same day, and then this process is repeated every single day. So what are the stats of these funds? Well, XDTE, which sells 0DTE options on the S&P 500, has a current distribution rate of 25% per year. QDTE, which sells 0DTE options on the NASDAQ 100, has a current distribution rate of 30% a year. And RDTE, which sells 0DTE options on the Russell 2000, has a current distribution rate of 34% per year. Now, all these sound like great chunky distribution rates, but as we've seen before, never just trust the distribution rates. Does it make them stand out on total return terms? Well, the total return chart shows that they all actually underperform HDIV.to. Now, I had a feeling that this was going to be the case because coming from the options trading world, I know that 0DTE options can be super volatile and you don't really give your options much time to be correct. In this case, just a handful of hours. Not to mention the cost to continually open and close options every single day will cost a huge amount of money in transaction fees. So you get a pretty big friction from the churn and the cost of high volume trading in a fund like this. And so far, XDTE, QDTE, and RDTE are a big no for me. And I would personally recommend you stay away from them for the time being at least. Both Americans and definitely Canadians, considering the 15% withholding taxes added on top of our regular taxes as a Canadian resident. Granted, these funds have only been out for about a year, so maybe, we give them the benefit of the doubt and wait to see how they play out over the coming years before we really decide to invest in them. But I'm going to be honest, not really expecting much to change. So let's move on and see what YMAG and YMAX have in store for us from a performance standpoint. Maybe they can save us and actually give us a viable weekly paying strategy that rivals HDIV.TO total returns. Now, YMAG and YMAX are weekly paying covered call funds from YieldMax ETFs. YMAG provides exposure to the Magnificent Seven stocks, which are Apple, Microsoft, Amazon, Google, Tesla, Meta, and Nvidia. So it's definitely a more concentrated and speculative covered call bet on technology. And this fund basically holds all 7 of its single stock covered call ETFs for each of these Magnificent Seven stocks. YMAG provides a current distribution rate of approximately 40% a year. And YMAX is a universal fund of funds where YieldMax pretty much brings together many of its different YieldMax covered call offerings into one giant fund. It includes many of the same single stock covered call ETFs as YMAG does, and adds in many more, such as Disney, JP Morgan, SMCI, PayPal, Coinbase, Moderna, some gold miners, and Bitcoin, and many more. Now, YMAX is definitely more diversified in its offerings compared to YMAG, and its distribution rate currently sits at 56% a year. Now, both also pay weekly distributions, so let's see if their high distributions hold up in their total return compared to HDIV.TO. And it's actually not bad. As expected, a more concentrated portfolio of volatile technology stocks does beat out HDIV.TO in some cases. However, the volatility of these funds is also much higher. So if you are okay with having higher returns in a bull market and worse returns in a bear market, these funds might deserve a place in your income portfolio. If you are American, consider these investment tools for your portfolio. However, if you are Canadian, the only place I could recommend adding these to your portfolio would be in the RRSP, because in any other investing account, you will be paying an additional 15% withholding tax on top of the other taxes for these distributions that may need to be paid. So that would automatically disqualify them from any place in my personal income portfolio. I tend to not hold income products in my RRSP. It's mostly saved for growth stocks and growth ETFs, whereas income is saved for my TFSA portfolio, which would get dinged a 15% withholding tax on US distributions. So if we throw all of these US funds we talked about today into one big happy total return chart, as of present day, the only funds outperforming HDIV.TO are YMAG and YMAX. So again, I would recommend to take a look at YMAG and YMAX if you are interested in investing in them and have the ability to stomach some larger than normal volatility. However, in pretty much all aspects, stay away from XDTE, QDTE, and RDTE. They are not worth my time and money, that's for sure. It is not worth sacrificing the massive discounts in total return just to get paid a little more often. Now, onto the brand new Canadian biweekly paying covered call funds, C-Day, S-Day, and Q-Day. Now, these 3 funds have been making their rounds in all of the Canadian income channels on YouTube and have been said to be great additions to your income portfolio. But I have had my reservations since their launch because I've already seen how poorly the US weekly income providers have failed to provide competitive returns. Now, the total return results with these covered call ETFs are to be taken with a grain of salt because they just came out like a month and a half ago. So the data is very limited. I personally will not be taking any positions in them for this sole reason. So there just simply isn't enough data to warrant their investment, regardless of what the performance is like right now. But I wanted to share them with you just in case it is something you want to try or just keep on your radar for the future. Now, C-Day, S-Day, and Q-Day are all Canadian biweekly paying covered call funds from Hamilton ETFs, the managers of my favorite covered call fund, HDIV.TO. Now, all 3 have a modest 25% leverage, just like HDIV.TO does, to help enhance overall returns, and they pay bi-weekly, so twice a month. Now, these 3 are all very similar to the US market ones we just looked at, XDTE, QDTE, and RDTE, in that they are also 0 DTE option strategies. Now, C-Day is a 0 DTE covered call fund for Canadian equities with exposure to the CMVP ETF, which tracks an index of blue chip Canadian dividend paying companies, which have outperformed the S&P TSX 60 with a little lower volatility. Now, C-Day is currently offering a distribution of 18 cents per share paid bi-weekly, which on an annual basis would be approximately an 18% yield. Now, SDAY is a 0DTE covered call fund, but for US equities with exposure to the SMVP ETF, which tracks an index of blue chip US dividend paying companies with similar performance and lower volatility versus the S&P 500. Now, SDAY is currently offering a distribution of 18 cents per share paid bi-weekly, which on an annual basis would be approximately an 18% yield. And lastly, QDAY, which is a 0DTE covered call fund, but with exposure to the NASDAQ 100 index. QDAY is currently offering a distribution of 20 cents per share paid bi-weekly, which on an annual basis would be approximately a 20% yield. Now let's throw these three products into the total return chart and see if their distribution rates mean anything for their total returns compared to HDIV.to. Now remember, take these results with a grain of salt because the data is super limited. These products just came out like a month and a half ago. So what we see here is that all three, without exception, underperform HDIV.to. As was true with XDTE, QDTE, and RDTE, the high volume trading nature of such 0DTE funds should not surprise anyone that it underperforms strategies where, options have longer expirations and have more time to expire worthless and out of the money. Now, as such, I personally can't recommend any of these three funds when compared to HDIV.to, not only from a performance perspective, although data is super limited, but also because of how new these funds are. I personally don't like to take the risk of putting brand new investments into my portfolio that really haven't had the time to display performance and show me what they're made of. But even if the data were not limited and the results were as is, I could not recommend looking at any of these funds to your portfolio. There is no need to sacrifice that much total return to just get paid more often. It just doesn't make sense. Now, all in all, these 0DTE weekly and bi-weekly paying funds, at least at first glance, seem to be more hype than they are really competitive covered call funds to our benchmark HDIV.to. Almost all of them, with the exception of YMAG and YMAX, underperform. So to reiterate, in my opinion, if I were to look at this chart and add any funds to my personal portfolio, I would only look at YMAG and YMAX. The rest are a hard no. XDTE, QDTE, RDTE, CDAY, SDAY, QDAY, all a big no. They do not perform well enough as of the current moment. In my opinion, it is not worth giving up that much upside in total return just for the privilege to get paid a little more frequently. Now, if you have stuck around this long, go ahead and catch another one of my videos right over here, or check out my channel right over here, where you can take a look at all the other content I have to offer about investing. Now, that's all for me today. I'm Patrick with Apex Wealth Collective. Take care, and I'll see you in the next video.